In the world of investing, we talk a lot about legendary people. But what about legendary blueprints? What happens when a company decides to copy almost exactly one of the most successful business models ever created? Today, we're going to deconstruct a company that's been doing just that for decades.
So let me just start with a really direct question. What if there was another Berkshire Hathaway out there? A company built from the ground up on the very same principles that made Warren Buffett's company an absolute giant.
And that, of course, brings us to the Markel Group. For years, people have called it the Mini-Berkshire, and for good reason. It follows the original blueprint so closely. So the real question we're digging into today is, how good is the copy, and how have they managed to make it their own?
Okay, so let's start by really looking at that blueprint. What is the core idea, the secret sauce, that Markel really borrowed from Berkshire Hathaway?
Well, the strategy is so powerful because it's so simple. At its heart, Markel is a specialty insurance company. But the real magic, the genius of it all, is what they do with the cash they collect from insurance premiums before they have to pay out any claims. They take that cash, it's called the float, and they use it to buy other businesses.
And that brings us to the fuel for this entire operation. It's a concept that is absolutely central if you want to understand how both Berkshire and Markel work.
That fuel is called insurance float. And what's really interesting here is just how simple the definition is, but how unbelievably powerful the concept is in real life. I want you to think of it like this. It's a giant pool of cash, almost like an interest-free loan from your customers, that a well-run insurance company gets to invest to make even more money for itself. It's an incredible advantage.
So this strategy creates a company with two very distinct but deeply connected engines. They actually work together, feeding off each other in this symbiotic relationship that drives the whole business forward.
So here's how the two engines work. Engine number one is the specialty insurance business. Its main job is to be profitable on its own and, most importantly, generate that precious float. Then engine number two, which they call Markel Ventures, takes all that float and puts it to work, buying a whole portfolio of diverse, private businesses.
And this visual right here, this shows you just how important that second engine has become over time. Markel Ventures isn't just some little side project. It is a massive, distinct source of income for the company, standing shoulder to shoulder with the profits from the main insurance business. That diversification is absolutely key.
Okay, but how do they decide where all this money actually goes? Well, it's not just a two-engine machine. Their entire philosophy on how to allocate their capital is guided by this really simple but really stable metaphor.
They call it the three-legged stool. The first leg is reinvesting in their core insurance businesses to make sure they stay strong and profitable. The second leg is using the float to acquire more wonderful businesses for their Markel Ventures portfolio. And the third leg? Any capital that's left over gets invested into a portfolio of publicly traded stocks. Altogether, these three legs create an incredibly stable platform for compounding value over the very, very long term.
The big takeaway here is this. Markel's competitive advantage, its moat, it isn't some patent or a famous brand. It's a mindset. It is the relentless day-in, day-out discipline in how they allocate their capital, always focusing on where it will get the highest possible long-term return.
All right, so this all sounds great in theory, right? We've got a brilliant blueprint, we've got these powerful engines, this disciplined philosophy. But what about the actual results? Let's see how this model has really performed out in the wild.
This is the ultimate question, isn't it? We can talk about strategy and philosophy all day, but has this Mini-Berkshire model actually delivered the goods for its shareholders?
And the answer is a massive, resounding yes. For over 2 decades, this company has compounded its book value per share, which is really just a key measure of a company's net worth, at an annual rate somewhere between 14% and 20%. That is a truly, truly remarkable record of consistent value creation over a long period of time.
And this right here gets to the heart of why understanding a company like Markel is so different. While, most of Wall Street is completely obsessed with the short-term drama of quarterly earnings reports, Markel's entire focus is on the slow, steady, long-term compounding of book value. They are playing a completely different game.
Which leaves us with this final, really provocative thought. In a world that demands instant results, that demands everything right now, is it possible that the ultimate competitive advantage is simply having the discipline and the structure to be patient, to focus not on the next 3 months, but on the next 10 years? When you look at Markel, it seems to be the lesson at the very core of their success.